Great. It's 11 o'clock. We should get going. Our guest this week is Helen Steers from Pantheon International. But before we do that, we're going to just look at a bit of news from this week. So I've picked out three things. Rich is not around us today, so I'm going to look at PRS REIT as well. Hansa Trust first. This is complicated, way more complicated than it needs to be. First thing you need to know is that there are two classes of shares. So there are voting shares and non-voting shares. The voting shares have market cap about 95 million and the non-voting 182. And the non-voting trade is slightly wider discount, but both those discounts are very wide. And there's not much of a yield. And the returns are okay, but not great really. I've ranked those by 10-year share price returns. You can see where they are. And the difference between the two just reflects the movement in the discounts, really, because the NAVs are identical. It's domiciled in Bermuda since 2019, and my hunch is that they've moved it from the UK to Bermuda, so they'd never be challenged about the non-voting structure. It's really controlled by just two individuals, part of the same family, brother and sister, and they own a majority of the voting shares between them. So with about 17.9% of the assets, they control the entire structure, which I'm not a fan of at all. And I've been saying for a long time they need to enfranchise the non-voting shares, but that's probably not going to happen, and there's no way of making that happen. Now, about well, not quite a third of the trust is invested in another thing called Ocean Wilsons, which is another investment company. And it's also domiciled in Bermuda now, and it owns an investment portfolio and a stake in a Brazilian company called Wilson Sons. And you can see the figures there as how that kind of breaks down a bit. So it's just announced, this is Ocean Wilson now, has announced that it's going to sell its stake in Wilson Sons for about 768 million US dollars, equivalent of. You have to take tax off that, so they're going to get, they don't know how much that tax is going to be, but they're saying the most it could be is 142 million. So they should get at least $593 million out of this, which is quite chunky. And that gives Ocean Wilson's assets of about $912 million, which gives it an NAV of about £19.88. And the current share price, as you can see there, has been coming up, but it's still only £14.30. So that's trading on a discount of about 28%. So it's quite chunky too, £500,000 worth. And it's got a much higher yield than Hansa does. So on a look-through basis, Hansa's share of those net assets is about £185.6 million. And that compares to its valuation in its accounts of about 137 million. But if you look at it just on the share price, it's 133. So obviously they can't get access to that. That's the discount basically. So there's not any massive uplift in NAV at the moment from this transaction for Hansa. But if, as it says here, Ocean Wilson's passes a lot of that cash through to its shareholders, then that effectively goes as the discount. So Hansa will get an uplift. So you should then see, if that special dividend happens, you should then see a jump in the NAV. So that's one thing to remember. And then the other thing is, because what's left of Ocean Wilson's is just all now investment portfolio, it'll have to reclassify as a closed-end fund. So at the moment, because it's got this big stake in Wilson Sons and that kind of dominates things, it's not classified as an investment company, or as a closed-end fund rather, in the stock exchange, but it could do. So it would come into our sector then. It's a fund of funds, which obviously we know has not been flavour of the month, but that should now change, hopefully, with the cost disclosure thing. We'll have to wait and see whether that makes a difference or not. It's managed by the same team that run Hansa, and that's important too, and that is owned by William Salomon again another guy. And it sits in their offices. So it's very much, they're all kind of in each other's pockets here. But it is important to note that Hansa does not control Ocean Wilson. So Ocean Wilson's can kind of do what it likes. What it won't be able to do is anything that requires a 75% those voting without Hansa's consent, because it's got over 25%. So it can't liquidate, for example, but I don't think it's thinking about doing that. So when it does come over, this is what the portfolio looks like. And you can see, I mean, that there's a few funds you might kind of recognize in there, some more things you might not do. Things like Pershing Squares in there, for example. Polycap Tech, but I think that's the open-ended version rather than the closed-end investment trust. Not a good reason, I think, of why you wouldn't hold a equivalent fund on a discount, but there we go. Worldwide Healthcare's in there. So yeah, but most of these things are either LPs or open-endeds. And it's decent size. And I remember that's going to be topped up by a lot of cash, so that portfolio should expand as well. So we'll see what happens with that. But it does look to me as though Hansa's still undervalued, but there's no way of forcing it down to close. And Ocean Wilson may be undervalued too. We'll have to wait and see. So that's that one. GCP Infrastructure next. One that we like. The discount opened up on the back of rising interest rates. As the NAV shows, there was really no need for that. There's not a lot of logic to it. But nevertheless, the share price did go way, way, way down. It has started to recover since, but has slipped in the last few months, and that's happened to a lot of these funds, actually. So that discount's way too wide, about 30%, and the yield is just amazing, so 9%. And that, I think, is pretty cast iron, but we'll have to wait and see what happens now. So what it's just announced this week is there's a small drop in the NAV, which is not the end of the world, to 105p. But they're not going to tell us why, and this is the interesting thing. So they have got this target to recycle 150 million of assets, and use that money to buy back stock and repay the outstanding debt it's got on the revolving credit facility. So they've sold 31 million quid worth of stuff so far. The balance on the debt is still 57 million. So we have to wait and see what happens. But it says on the 24th that it's in active due diligence and negotiations on disposals of material components of this portfolio. So my guess is, and this is only a guess, that this is the social housing part of it, which is a fair chunk of the fund, and it's something they sort of said they want to get out of. So if that does happen, and the reason they're not telling us what drove the NAV move is because they don't want people to work out, they don't want the buyers to work out what they think the value of the social housing portfolio is. You know, the negotiation, they don't want to do that. But it seems to me quite likely that we are about to see a big disposal announcement here, and that would allow them to pay down that RCF and start more buybacks. And the timing of this seems to be fairly soon, because they're saying that they will be publishing the NAV move in the accounts in December. So I'm thinking that we should get something in the next few weeks, but we'll just have to wait and see. That's pure speculation. PRS REIT is the only other one we want to talk about today. Now this one, the NAV is just marching up there. Again, we've got the discount widening out with the interest rate rises. We've got this discount closing recently, and that's all related to corporate action. I'm going to talk about in a second. But again, that discount is still a bit too wide, about 20%. And the yield is an enormous 3.8. So it's all designed to build houses and rent them. It's in the name. And they've almost finished their initial building program that they set out to do. So they're targeting 5,576 houses, and they've built 4,400 of them. Those are occupied, they've got tenants in them. The only reason why obviously dipped a little bit is because they just completed a whole lot of houses, haven't quite let them yet, but they should be running about 98% on a kind of normal run rate. And obviously people constantly want to move out and you have to replace them with new tenants. So it's never going to be 100%. Rent collection is pretty good. There are some rent arrears, but they're tiny in the scheme of things. They're getting very good rental growth, which is something that we've seen across the whole of the residential market. A bit more for new tenants coming in than they do have for reletting to existing tenants. So that's still pretty good. That's one of the things that's been driving NAV higher. They've been trying to drive down the property management costs, but they can never get, that kind of 8.8. It may be high-ish, but I don't think they can drive it down a lot. And on the back of all of this, they're generating more income, so they're thinking about whether they can put the dividend up. So on that basis, I think really this is just firing on all cylinders. It all seems to be going the way it should be, but there is a new board in place because of what happened we've talked about in previous shows. So it all came back. It was all triggered by the board extending the manager's contract, and we were quite adamant that was the wrong thing to do. And now with new directors imposed on it, it's launched a strategic review. They're badging this as a formal sale process. That's a technical term under the takeover code, but it means that they can talk to people without having to tell shareholders what's going on, so it's and do it privately. Nothing's had started on the 23rd of October, but I would imagine that things are going to start quite quickly here. And I would also imagine that we're looking at a sale of the whole business, but for what price, I cannot tell you. And all of this just seems a real shame to me, because in an ideal world, I think they should be selling the portfolio and recycling that money to build more houses. We obviously need to build more houses. There obviously is money to be made from building more houses, as they demonstrated already. And they should be just getting on with doing that. But it seems more likely to me that the whole thing is going to disappear and get wound up. But we'll just have to wait and see. So that's enough from me. Now let's talk to Anna. Good morning. Thank you very much for doing this again.
Good morning, James. Great to see you again.
So I'm just going to hand over to you for a bit and let you just run through your presentation, please.
Fantastic. Great. So just a quick introduction for those that don't know me. My name's Helen Steers, and I'm a partner at Pantheon, and I'm the co-lead manager for Pantheon International Plc, which is our FTSE 250 quoted investment trust. So thanks to everybody for joining us this morning. I will run through a bit of a progress update on our corporate strategy. I'll talk about our annual results, and I'll also give you an update to 30th of September. We had our NAV actually released yesterday. I'll talk a little bit about the portfolio and try and give you a sort of an outlook on where we see things going in the private equity world. So maybe just to kick off and to recap on some pretty big moves that we made in terms of our corporate strategy last year and kind of where we are at the moment. So as I think many people will be aware, we launched a very large buyback last year, 200 million that we promised to invest in PIP's portfolio, so capturing the value in that portfolio when it was trading at a pretty large discount. The summer before last, our discount had widened considerably to beyond 40%. We managed through a reverse tender, a very democratic process, to invest a large chunk of that 200 million in share buybacks. So during the financial year, it was 197. That resulted in an uplift to NAV per share for the full financial year of 4.7%. So really capturing value for shareholders there. There was a side benefit as well. That tender offer resulted in a bit of a refresh share register. We had a couple of shareholders at PIP who'd been with us almost since inception, and we've been around for 37 years. And PIP had been a bit of a victim of its own success, and that shareholding had become very large for a couple of shareholders. So it enabled shareholders to trim and other shareholders actually to come in. So we were pretty pleased with that sort of side benefit. We then announced our revised capital allocation policy, which has been well received by the market, by commentators. And the idea there is that we will continue to buy back, and there's a promise there to buy back shares when the discount is wide, and that share buyback policy is tied to the cash that we generate from the portfolio. And just to remind people, this is a very cash generative portfolio. For the last 10 years, we have generated 1.6 billion pounds of cash over that 10-year period. So it's a natural extension of what we did last year, and it's an ongoing policy. So those are really sort of steps 1 and 2 in our corporate strategy. The one which I think is really exciting is step 3, which is enhancing our marketing efforts. So clearly, capturing the value for shareholders was really important, but we never thought that a big buyback would be the silver bullet that would cure the discount issue. And I think if you look around the market, a lot of other people have now sort of been doing buybacks. Very, very difficult to shift that discount. It's a sector-wide issue. But what we can do is really step up our marketing efforts. So we announced actually in our annual report that we'd be engaging a marketing agency. It's the first time PIP has done that, although we do have a good PR agency. So we've engaged this marketing agency, and we are now embarking on a pretty big initiative to attract new investors. So basically drumming up more demand for the trust. So we hope to report on that soon, but so far so good, and it's very interesting working with the marketing agency. So maybe just sort of moving on then to talk about portfolio. As you're aware, PIP provides access to a high quality global diversified portfolio of private companies. We've been managing it since 1987, so it's been around for 37 years. And I'll talk about progress in the portfolio, but over the last 10 years, we've been gradually moving the portfolio to have a bigger exposure to direct positions in private companies. And you can see now on the left-hand side, that snapshot shows that 54% of the net asset value is now invested directly in companies through either co-investments, where we invest directly in the business, through usually through some sort of SPV with our private equity manager, and then also through manager-led single asset secondaries. Bit of a mouthful, but essentially, again, it means we take direct positions in companies. We still have some funds part of the portfolio. The primary funds have also been slimmed down to really focus on a few key private equity managers whose funds are routinely access constrained and invitation only. So we're providing access there to some of the very top managers in the world through their funds. And these are complementary to what we do on the co-investment and single asset side. In terms of stage, you'll probably be aware that PIP is very much a buyout fund, buyout vehicles, so quite mature businesses, but with an emphasis on the small and mid-market part of the spectrum. We like small and mid-market buyouts because generally we're buying businesses from founders or from entrepreneurs. There's a control element there, and there's a lot you can do with those businesses to grow them until you exit in probably about 5 years. And then when you do exit, it's generally not through an IPO. That's really a tiny part of our exits, about 10% of our exits. Generally, we're selling those businesses to strategic or trade buyers. And the second exit route is to other private equity funds. Regionally, we are a global vehicle. It's a global structure. We've got more than 50% in the US, which is the deepest, most sophisticated market in the world for private equity, but there's a lot of specialists, particularly in the areas that we favor, which are information technology and healthcare. And then a good chunk in Europe with an emphasis on Northern Europe. So UK, Germany, Scandinavia. And then if we move to sectors, so this is on a looking through to the underlying portfolio company sectors, you'll see that more than 50% of the portfolio is in what we consider to be the most resilient parts of the economy. So information technology and healthcare. Information technology really driven by long-term secular trends towards more digitalization and automation. These are what I would call boring technology companies. So they're providing things like accounting software, payroll software, cybersecurity software, things that you need to run your business, which are generally the last things to get turned off in a crisis, and where you can put through pricing increases really quite easily. These are essentially must-have, quite defensive products and services. Healthcare driven really by the aging population in the developed world. So there are products and services which cater for that. I should point out that the consumer part is very much focused on consumer staples and services, not consumer discretionary. And that's very key because we want PIP's portfolio to be a portfolio for all seasons, a real sort of all-weather portfolio. So maybe just moving on to the next slide to talk about progress of the portfolio. So we're very happy to report that during the financial year, despite the fact that we had a more muted exit environment, we still managed to exit at actually beyond where we have exited in the past in terms of an average. So our average cost multiple upon exit for the year was 3.2 times cost. That compares with an average over the last 12 years of 3 times. And if you look at where the average holding multiple is in the portfolio, 1.6, you've got a nice potential uplift there in the portfolio. So we're quite pleased actually with that result. On the right-hand side of this slide, you can see that our annualized revenue and EBITDA also held up very well. During the year, the revenue growth was actually 14%, the EBITDA growth was 17%, so very much in line with our 5-year average, which is 17 and 19. So we're pleased again with the performance of the underlying portfolio. The figure in the middle may surprise certain people because everybody always thinks that private equity is very risky. We're more of a buyout group, so we've only got about 4% exposure to venture, and I think that's reflected in this rather low loss ratio. So if you take the capital that we've actually lost and capital that's impaired, and you compare that with how much we've invested over the last 10 years, that's only 2%, just over 2%. So to look at it another way, 98% is sitting above cost. So we actually retain a great deal of confidence in our portfolio, and I think it goes back to those resilient sectors that we're invested in and the very high quality private equity managers that we work with. So maybe just moving on to talk about exits, since I have mentioned that. It was a slower year for exits, and I think that's typical of the entire sector, and it's typical of what we've seen in M&A in general over the last 2 years. Our reading of that is that there's been a lot of uncertainty around. So, where is inflation going to end up? Where are interest rates going to end up? And that's really impacted M&A, and that's impacted the number of distributions that we've seen from the portfolio. However, we've still seen a good average uplift on the exits during the year. In the year to 31st of May, it was 20%, which is a little bit low, our weighted average of 30%, but still in line with our historical experience of uplifts. So a little bit below, but we're still very happy with that. I already talked about the cost multiples, 3.2 in the period. And there you can see on the right-hand side, the annual distribution rate, which is really at a historic low. And that to me says that actually we've got a lot of sort of pent-up exits in the portfolio. And anecdotally, as we speak to private equity managers, there's a lot of companies that are now being put on the exit ramp, but that's not yet translated through into actual exits or indeed distributions. So moving on to performance. So these are the results for our financial year, which ended 31st of May. I already mentioned some of the headlines a little bit earlier. So we saw 6.1% NAV per share growth in the year, and that was made up of a contribution from the share buybacks of 4.7% uplift, and a contribution from valuation uplifts in the portfolio of about 5%. So pleased to see both of those contributing to NAV per share. We did have a headwind from foreign exchange, which I'll talk about in a second, because 75% of the portfolio is US dollar denominated, and with the strengthening of sterling over the period, we did see a headwind from foreign exchange. The annual NAV per share growth over the past 10 years, it's been 13.5%, which we're happy with. And the share price was actually moved quite a bit more. So we had close to 20% share price movement in the period. And I think that was probably a reaction to the buybacks and to the announced capital allocation policy. If we move on to the next slide, there you can see that breakdown of the NAV per share movement, which I just mentioned. So valuation gains, share buybacks, both contributing, but then we do have the impact of FX. And I should mention here that it's really difficult to hedge in private equity because you don't know your cash flows and you don't know the timings of the cash flows. So I think almost universally in the sector, people don't hedge. And over time, that movement in foreign exchange usually balances out. We were pleased to see, you can see on the right-hand side here, that the valuation movements in the portfolio were positive across the board. So in the previous period, we'd seen a downdraft on the venture side, and even though it's only 4% of the portfolio, it's nice to see that turning around now and seeing venture tick up. And then we've got, good solid performance from the buyout part of the portfolio. And again, we believe that our diversified strategy and this access to both top performing managers, but also the ability to pick the best deals that those managers offer to us in terms of co-invests and single asset secondaries is really helping the performance here. So just moving on to the next slide, we've got an update actually on the performance in this financial year. So we just announced our NAV yesterday. So this is performance as of 30th of September. Now these numbers are still very much based on June marks. So obviously we're not seeing September marks come through yet. So about 91% of the valuations are based on June. There's a small amount of the portfolio which is public, where companies have gone public, around about 8%. So those are actually marked to the actual mark. In the period, you can see that we continue to have valuation gains, but we did have this impact of foreign exchange, which you can see there in the red. So there was a small decrease in the period, but a lot of that is attributed to the foreign exchange impact. We continued to make new investments and announced that actually in our newsletter yesterday, alongside these share buybacks. So we continue to invest in the portfolio, but also critically in laying down new deals, new vintages for the future. So maybe just moving on a little bit to talk about cash generation, and then the balance sheet. I already talked about distributions being at lows. You can see here these are quarterly distribution rates, which have been on the low side now for the last 2 years. And equally the core rate. So this is where we're being asked to contribute capital to new deals which are being written by the private equity managers. So this comes from our primary part of the portfolio. Those core rates are also down, and it's really two sides of the same coin. If exits are low, that means there are fewer deals being done, and therefore the core rate is low. And the result of that is that we're still producing net cash flow. So even though distributions are down, calls are down too, and the net result of that is we still produce net portfolio cash flow. And as I said at the beginning, it is a naturally cash generative portfolio with about 1.6 billion generated since 2015. The balance sheet on the next slide is in a very good place. We refinanced our revolving credit facility last year, and we did that on good terms, and we replaced 3 lenders, one of which was Credit Suisse, with 5 lenders, and none of those were Credit Suisse, so we're quite pleased about that. And then also we did a private placement of $150 million with 5 very high quality North American insurance companies that bought that, and that's cheaper money actually than the RCF. So whereas in the past PIP had been run, probably if I'm honest, with a little bit too much cash on the balance sheet, we've now got rid of that cash drag, and we have a small amount of net debt. It's about 9% net debt to NAV at the moment. But really with a very solid structure. And you can see there on the right-hand side, that we've got a close to 90% undrawn coverage ratio and 4 times financing cover. So, robust coverage ratios, and, that should give, I think, shareholders a great deal of confidence in the financial situation of the company. So just moving on to I think this should be the last slide. This really sums up PIP's performance over the last 37 years. So launched in 1987. The annualized NAV per share growth over the last 10 years, and this is to 30th of September, has been about 12.5%. And clearly that's net of all fees. And then our very long-term 37-year history is 11.7%. You'll see there the very stark sort of gap there between NAV and share price. So we're still trading at a discount which we think is unreasonably large. It's about a 33% discount. And as we think about the quality of the portfolio, as we think about these uplifts to holding values that we get when we exit, we do think that discount is unjustified. We are keen to show that the portfolio is in a very good place, got lots of very high quality businesses in there, and we do believe that distribution rates should pick up in the future as exit activity returns to the market. But overall, I think it's a good picture. PIP continues to be a very effective way for shareholders to get access to what is a very exciting asset class, private equity, on a global basis, liquid format. And with that, James, I think I can turn it back to you.
Thank you very much indeed. So we've got a few questions. Any quick and easy one first. Who is the marketing agency you're using?
Oh, I'm not sure whether it's been announced publicly. Can I get back
Sure.
to you on it, because I wouldn't want to say something that I'm not allowed to say. But yeah, I can get back to you, James, on that. Apologies.
Now, more serious stuff. In terms of the cash that you're generating,
yeah.
So we talked. What's the slide? I can't remember. Is it mostly coming from sales of things, or is there sort of a natural cash flow off the portfolio as well?
Yeah, great question. This is a capital growth portfolio. So essentially, the cash comes from the realization of the assets. There's very little here in terms of investment income. It's not an income generating type of portfolio. What we're looking for is that big pop in capital growth.
Fair enough, that makes sense. In terms of the size of deal that you're invested in, is there like a sweet spot here, or have you got sort of stuff across the whole range of different size of deals?
Yeah, we are. I suppose go to the portfolio slide there, the snapshot slide, and I did run over this quite quickly, but if we go a little bit further back, yeah, you've got those sort of pie charts. Yeah. So on that stage side, we are really focusing on small and mid-market buyouts, and there you're talking enterprise values of between sort of 250 million euros or dollars at the small end, all the way up to probably close to $1 billion at the large end. That's really our sweet spot, is where we think there's a lot of value creation that can take place. And a lot of that is to do with strengthening management in the portfolio companies, is to do with improving reporting, because often when a company has been, in pure private hands for a long time, the reporting is substandard. And also doing things like, helping with things like procurement policy, supply chains, sorting out companies' marketing strategies, go to market. So we like that. We also like the fact that then generally we're selling to strategic or trade buyers. The companies are small enough to do that, but they're not so small that a trade buyer is not interested. And then we also sell to the bigger buyout funds, and people will probably be aware that a lot of money has been raised by the mega funds over the last 2 or 3 years. So, $20–25 billion funds. Those funds come in and buy our portfolio companies, either as platform businesses or as add-ons to their existing businesses. So it means we've got a lot of exit routes there as well, which is helpful, particularly in the current environment.
Great, thank you. In terms of the sort of sector spread,
Hmm.
question here around because you mentioned them. Have you got exposure to the media companies, education, that sort of thing?
We do. Education, actually, interestingly, would be in consumer services. So yes, we do have exposure to some education companies, both in Europe, actually in Europe, the US, and in Asia. In fact, we just announced a co-investment. It was just in our newsletter yesterday in a business which provides sort of flexible learning solutions for K-12 students in the US. And often these students have been sort of failed by the current system. So that's an interesting deal that we've done in that sector. In Europe, we've also invested in sort of private colleges and universities. That tends to be quite resistant and resilient in a recession. In fact, often it's a little bit counter-cyclical. People tend to go back to full-time education sometimes in a recession or more difficult times.
Um, Given there's not very much to the portfolio, why bother with venture at all?
Yeah, yeah. Good question. So venture is a bit of a sort of a rarefied beast. With venture, it's only worth doing it if you're in absolutely the top managers in the world. Whereas in the buyout field, the spread between the top quartile and the third quartile manager is about 2,000 basis points. So about 20%, which is very wide compared to public market managers. In venture, it's kind of off the chart. Is almost impossible to measure. So we try and invest in the top decile managers. So names like Index Ventures, Axel, Andreessen Horowitz, because we've got access to those managers and a lot of even institutional investors, pension funds don't have access. We feel that we are offering something to shareholders that they really couldn't get elsewhere. And the truth of the matter is that those venture managers, if you're investing with the really top ones, they can produce, not the kind of the 3 times cost that we report in the buyout portfolio, but they can report, 5, 10 times cost on their deals. So we think it's a nice boost to the portfolio, but it's very difficult to expand that beyond the 4% because if you start scaling that further, you'll probably have to accept lower quality managers, and we don't want to do that.
Fair enough. In terms of the co-investments, how big is an individual deal within?
Mm.
Oh, yeah.
Yeah, so PIP, and I probably should have mentioned this when I got to that slide. PIP invests directly into the deals that is offered by Pantheon. So PIP is not a download into Pantheon funds. So the co-investments are selected for PIP and for other Pantheon clients. And our average sort of bite size in a co-investment is probably around about $35 million or euros. But it can vary quite a bit. It can vary from sort of 10 million at the low end, all the way up to kind of 100 million at the top end.
And if an investment gets to be very big because it performs very well, gets written up, do you top slice it or you just let it run?
We kind of let it run really because we have, it's a well-diversified portfolio. 80% of the NAV is accounted for by just over 500 companies. So it's well diversified. The top company in the portfolio, which actually is Action, or maybe it's number 2 at the moment, is only about 1.2% of the NAV. So we don't think that's a problem. If it was much bigger than, if it was over 10%, that might be a problem, but it's only 1.2%. We have had companies in the portfolio that have done exceptionally well and have got to kind of, 4.5%, 5% of NAV, and then they've been sold, and then we've recycled the cash. So, I think it would be unlikely that we would, take a slice off unless, there's an exceptional circumstance.
Well, you've just answered the question, do you hold Action?
Yes.
And maybe I can't say, but would you hold it at the same valuation that they do, or are valuations different between managers even in the same deal?
That is an excellent question, actually. No, we take our valuations from the private equity manager that is managing the business. So we have a direct stake in Action, and we bought it actually through a manager-led secondary, so essentially through 3i. And that deal is marked to the same valuation that 3i marks it to. Now, there are occasions when we might take a different view on a valuation to a manager, but they tend to be few and far between because we take the view that the manager that is deeply embedded with the company, sitting on the board, has been following it for a long period of time, probably has the best view on the valuation of that business.
Yeah, fair enough. In IT, what sort of exposure have you got to AI? Is that sort of theme that you're trying to develop, or
Yeah. So I suppose the easy answer to that is that AI really permeates everything that we do, and it actually goes beyond the IT sector. We're using AI in healthcare too. So, for example, we have a co-investment we did in the portfolio in a company called Medica, and Medica is actually a UK-based business, works with the NHS. It provides teleradiology services. So it interprets X-rays, MRIs, CT scans, things like that, and it does it at a distance. And it has the opportunity to use AI to do a lot of kind of the heavy lifting there. So AI actually is used in a lot of companies through the portfolio. What we don't have is the leading or bleeding edge AI businesses, because those are too speculative. So essentially, we use AI. In fact, one of the biggest companies in the portfolio is a company called Caisse, which again is a co-investment, and that business is sort of AI-powered cybersecurity. So using AI as a tool is prevalent in the portfolio, but we don't try and invent new AI tools.
Yeah, that makes sense. And actually, within energy, is that renewables or fossil fuels, or
That's a legacy part of the portfolio, James. So if you'd looked at the breakdown in a year or two ago, it would have been more like 3 or 4% in energy. Those are traditional energy businesses. We haven't been making any new energy investments for probably the last 3 or 4 years, and that part of the portfolio is basically distributing and is being sold down. And we stopped investing really for 2 reasons: ESG reasons, clearly, but also energy is very much tied to the commodity cycle, and we don't want to have to deal with things that are not within our control in the portfolio.
Great, thank you. USA, obviously, big part of the portfolio. Are you at all concerned which way the election goes?
Well, we're not sure what's going to happen with the election, are we? The beginning of November. I don't think so. I mean, interestingly, people talk more generally about sort of macroeconomic and political impact. For private equity, it's really more about the micro. It's about the companies and about where they're positioned, about the micro sectors that they're involved in. So, unless there were some, really major changes, I don't see either, candidate really having a huge impact. But I'm not a US pundit, James.
Out of the start. And then obviously with the dollar and the actually index moves. So in terms of the debt, would it make sense for all of that RCF to be in dollars rather than
So, so it's denominated in dollars and euros because we also have outstanding commitments in euros, and the split between the dollars and the euros is split according to the outstanding commitments that we have. So there's a matching there. It's a very good question.
That will make sense. Good. Then, in terms of narrowing the discount, I mean, obviously, all credit to what you've done so far. Is there a point where the discount would be acceptable? I mean, is there a sort of target in mind of where you think it ought to be?
Well, we think it should be 0, James. We don't see why because the portfolio, if you look at where we exit, on average, over the last 12 years, we've been exiting at about a 30% uplift to carrying value. So there's a lot of embedded value in the portfolio. We've got a lot of confidence in it. With the way that the portfolio has moved, more towards the resilient sectors, more into co-investments, single assets that we've got a lot more control over, we think actually we ought to be trading a great deal better than we are. So no, I don't think we should really have any discount at all. And we're working very, very, very hard to basically influence demand. And we are seeing buying. We're seeing buying from new shareholders. It's probably worth mentioning at this point that our directors hold they've got a lot of skin in the game, as do the Pantheon partners, but the directors hold about, I think it's 4.3 million shares. John Burgess, who is one of the sort of senior directors on the board, who's a private equity veteran, has recently been adding in a pretty substantial way to his holding, which is always a nice sign, when the directors are buying.
Yeah, exactly. Dividend. Some trusts sort of pay a dividend out of capital gains.
Yeah.
Is that something you've thought about, or does it not make sense given where the discount is?
We've thought about it a great deal. We've talked about it with the board a great deal. We've talked to shareholders about it. So we've spoken to different types of shareholders. The reality is that with any of these sort of capital growth vehicles, and our peers are in the same situation, if you pay a dividend, you're paying it out of capital. We don't generate much income, as I mentioned earlier. So it would be kind of an artificial dividend. And the feedback that we get very strongly from our shareholders is that no, they would prefer not to have the dividend.
Yeah. I mean, there's more bang for the buck in using that money to buy back shares at discount than would be.
Precisely. Yeah, precisely. Yeah.
When you were trading a premium back here, you were issuing stock.
Oh gosh, that is long before I took over managing the trust. I think there might have been some small share issues, but we were a very different animal at that point. We actually had two different share classes. There was an ordinary share class and a redeemable share class, which we combined actually, and we merged in 2017. So there may have been some small share issues, but they would have been, really quite tiny.
Great. I think we have exhausted the questions, but
Gosh,
thank you very much. We covered a lot of ground, definitely. Now I'm aware there's a huge number of disclaimer slides here. So
I should have apologized about that at the beginning.
People are going to have to freeze frame them if they want to read them properly. I think they probably, they should do, obviously. But thanks very much for doing this. And there's a question that hasn't popped up, but quite often pops up, is the extent to which you've got a stake in the fund. Do you mind telling us that?
Yes, I have a pretty substantial stake in the fund, as do Pantheon partners. So yes, I'm a big shareholder, and not as big as John Burgess, unfortunately. I think he's the biggest of the. I think he's like number 18 on the share register. So he's a very big shareholder. But yes, I have a substantial stake, and actually what I do is I put money in from I do regular buying, so I do kind of dollar cost averaging, which I think is good for a lot of people.
And in the interest of full disclosure, so do I have shares in it as well.
Oh, great.
We're interested in the discount coming down.
Yeah.
So thank you very much for your time this morning. And we'll get you back again in a year or so and see how it's been going. But
we're delighted to be here, James. Thanks for all the questions. It's great to be here. Thank you.
Cheers.
Bye.
So we'll be back next week talking to Joe Curtis of City of London. So it's like change of tack in terms of what we're covering, but should be interesting. And I will obviously, because it's the 1st of November, we'll also have Andrew McHattie with us as well. And then, as I said before, we've got a sort of full lineup of things all the way through to the end of the year. So thank you very much for tuning in today. And if you haven't voted yet in the awards, please do so. Have a good weekend, and I will see you next week.